All right, hello everybody. Welcome back to the FIP4X webinars, the way we go about it. And today we're going to talk about the crucial factors of money management. Today is theory, as what I would call. There are no charts, so I'm not going to go over the charts too much like we did in the last time. The important factors of risk management, very important to trading and something which every trader must know. So let's go right ahead. Okay, so as we said in the introduction, ask any professional trader the secret to success, and they would most likely mention risk management. It is the most important factor responsible for success or failure. Now, within the parameters of risk management, so there are a lot of factors, I would say, for risk management. You have risk to reward ratios, you have win loss ratios, you have position sizes. A lot of traders, and especially new traders, when they come in, they tend to give a lot of priority to the win loss ratio. Now, of course, it's a natural thing, and obviously having a larger number of winning trades is good for the account, but there are other crucial factors which are not looked at so much, which are not given priority, as I would call. So what I want to go over is these things. As a trader, something like these things you should be aware of, and it is a very crucial factor for the success of your trading. For example, do you know that whatever markets you decide to trade and the time frames that you decide to trade on should ideally be decided by these factors of risk management? I mean, most of us, when we come into trading, we decide on an instrument. Let's take Forex, for example. So I've been trading Forex for so many years now and decided I want to trade Forex. And depending on what I want to do, I decide that I want to trade on this time frame, depending on the time that I want to give to the markets. But ideally, when my risk management policies are in place, these risk management policies that we'll go over should decide what instrument you should be trading and what time frame you should be trading. A very, very important part of what you're doing. Okay, so going over some basic stuff, trading any markets, the statistics say that 80 to 90% of the retail traders lose money. Now, this is something we've gone over earlier, but worth going over once again. Retail traders are individual traders like you and me. We are not talking about institutes, we are not talking about banks, we are not talking about funds. Retail traders, individual traders like you and me. So research has showed, on we know it, that almost 80 to 90% of the retail traders individual lose money. Of course, there are substantial risks involved in trading, but the simple fact is, if there are a certain number of traders who are able to make a successful living from trading, that means there must be a way. But this demands what I call as an in-depth understanding of how the markets work and various factors that make up the trading process, which again, I always say that I've been trading for about 20 years now, more than 20 years. It took me a considerable amount of time to become consistently successful. And I had no mentor. I did not really, have anybody to show me around. If I had, I would have probably saved, a lot of time and money. I'm sorry. Chris says the sound is not okay. Could you just confirm if voice is okay or there's something wrong? Are we good on sound? Everybody? Okay. All right, Chris. Thanks. So going through these. So if there is a small number of retail traders who are successful, then obviously there is a path. When most traders start their trading journey, like everybody else, like I did, everybody assumes the way to success have a good trading system. The holy grail is what everybody looks at, but successful trading is not just having a trading system. It's a combination of various factors, which I call as a 3Ms. Until you incorporate these 3Ms into your trading, the likelihood of success is low. So very briefly, going over the 3Ms once again, this is something which I keep repeating again and again in all my sessions, but this is very, very important. So the 3Ms are money, mind, and method in that order. So money is your risk management policies, your money management, which is first. Second is your mind factor, which I call as discipline and patience. And the third is the method. Now, if we distribute these on a scale of 1 is to 10, the risk management takes up 5 parts out of 10. The mind factor takes up 3 parts out of 10. And the method that we all talk about, we go to the charts, we look at indicators, we look at trading systems, takes up only 2 parts out of 10. So if you look at it, your method is the least important part of your trading. Now, this does not undermine the importance of technical analysis, fundamental analysis. The fact is that your techniques, your systems, your method must be combined with the money and the mind. And when new trader who comes in, he or she usually does not do that. I'm talking about the inexperienced traders who come in over here. And when they start up, like I said, new traders, and when they look for trading systems, yeah, absolutely, Mirzan. This is exactly where most traders tend to lose money because they concentrate on the wrong facts. And honestly, I'm saying this is not the new traders' fault, because if you do a Google search today, or if you look for trading systems, techniques, successful trading, you do a Google search for that, you'll come across a lot of trading techniques. Most of them, 90% of them, talk about indicators first, and those, they do not concentrate on the risk management or your mind factor. So obviously a new trader who's got no knowledge about this, the trader thinks that this is the way to go because everybody's talking about this. So obviously this new trader goes down a wrong path. This has always been my endeavor over here to put people on the right path. Whether you may succeed or not, that's a different matter altogether, but at least go through the right steps. It is going to save you a lot of time, efforts, and money, literally, to do that. So coming back to this, most people tend to concentrate on the method, and on the method they look at indicators. Everybody talks about indicators. So out of these 10 parts, the new trader follows only 0.5 parts. So is it surprising that this new trader really fails? It's not surprising. So let's talk about the 3M. So I'm going to start with money. We are going to talk about money over here, and we're going to, at the end of the session, we are going to go over the mind and the method factor in a very small way. But this this session, this webinar, is all about money. So let's talk about money. First and foremost, we are here to make money from the markets, obviously. So what should your priority be? I always say, as a trader, when you are a trader, your first job is of a money manager. Your job is to conserve your capital. Obviously, your capital is your bloodline. You don't have money, you cannot trade. It's just simple as that. So preserving it becomes a matter of utmost importance. Now, going about this, there's a particular ways or understandings on how you should understand the importance of protecting your capital from losses. Losses are a part of trading. There's no way that you can avoid it. But how do you conserve your capital in spite of the losses, right? So controlling the losses is crucial. You cannot control the number of losing trades that you have. That depends on the market, but you can control the amount of losses that you can take per trade. Now, simple mathematics. A single loss is not just a loss of capital. It puts you as a trader 2 steps behind in your quest to profitability, because mathematics says that the percent gain you need to recover from a loss increases exponentially with every loss. There's a simple table which I keep repeating again and again over here. Now, simple fact, if you just take this, right? Let me take this. Let's take there's loss of capital and gain to recover. Let's take the middle one. If you have lost 50% of your capital, roughly, let's say you have lost 50% of your capital, which means, let's say if I've got a $10,000 account and I've lost $5,000 out of that. Now, to recover back, it says you are going to require 100%. Now, what does that mean? It simply says that from 5,000, I need another 5,000 to get back to break even. So on my existing capital, I require 100% of my capital to get back to break even. And then my profitability starts after that. So obviously, if you look at this, the smaller your loss, the faster is your gain to recovery. The simple mathematics you must understand from this, that you have to keep your losses small. Now, once again, you cannot control the number of losses, but keeping them small is your points of your risk management. There your money management policies come into play. So conserving your trading capital is just not a simple process of keeping your risk limited. You must have a set of money management rules. Now, there are two golden rules of risk management that I refer to, something that I follow, something that I keep telling my traders, everybody around. There are two, these are basic rules, simple rules, everybody knows this, but most people don't tend to give that importance to them. If you simply follow these two golden rules, it will automatically put you in the top 10% of the winning bracket. Believe me, it does. Once again, it's very easy to say, but most people don't concentrate on this. So the two golden rules, the first most important one, which I call is the risk to reward ratio. You must maintain a minimum risk to reward ratio of 1:2. That means, simply put, if I'm taking a trade and if my stop loss that I have kept, which I will be keeping a stop loss, obviously, is, let's say, $50. My expected profit from the trade, I'm saying expected, it may not happen, but my expected profit from the trade must be at least $100. If I do not have an expected profit, I will not take the trade if I don't have 2 times the risk of what I'm risking of my capital. Now, obviously, when we have a system, we should decide before we get into a trade, where is my entry, what's my stop, what's my target. This is part of your trade plans. So if my trading system, whatever I'm following, says that this is my risk and my expected profit is not twice, I will not take the trade. So this is very important. The second is correct position sizing. Now, you should not risk more than 1% of your capital on any single trade. You can go up to a max of 2%. That means you can have 2 open trades at any given time, each with a risk of 1%. Now, this position sizing, it's an entire topic altogether. And maybe later what we'll do is we'll do one more webinar on the correct position sizing itself. But today we're going to concentrate on the risk to reward ratio, right? So correct position sizing and risk to reward ratio, these are the two crucial factors. Now, before getting into the details of these two golden rules, okay, first here, importance of these two golden rules. I mean, I could give you the most effective trading strategy, but if you don't follow this, your account has little chance of growing. On the other hand, if you strictly follow these rules, your account would tend to grow regardless of whatever strategy you follow. I've written over here and I joke about this, that if I have my rules in place, I can trade with the toss of a coin. Heads I go long, tails I go short, and still my account would tend to grow. But then we are not here to do that. So your trading system, as I said, is not really as important. You could have any trading system concentrate more on your risk management policies. So very briefly, position sizing rule number 2, it simply means risking a very small percentage of the trading capital, which enables the trader to sustain small losses while maintaining the account growth. Now, you can correlate this directly to leverage. In trading, high levels of leverage are available on all trading instruments, and especially in Forex. Forex markets work on leverage because of the nature of the market. Leverage simply means that with a small capital, you can control a larger position. Now, which simply means you are risking a larger amount of your capital. Now, leverage is a double-edged sword, as they say. The use of proper leverage can increase profitability. It also puts your account at risk. So correct position sizing becomes very important. Like I said, we'll go over this some other time. We will have maybe another session on position sizing, because this is also a very important aspect of your trading. Before going over to the risk to reward ratio, let's talk about this win loss ratio, which a lot of traders tend to concentrate on. And this is something which, from experience, I can tell you. I talk to traders, we have courses, I come across a lot of traders. I find them, when I talk about risk management, a lot of them tend to look at your win loss ratio, that this is the amount of win I had, this is the amount of losses that I had. And my intention over here is to, you know, give it its due importance, but in terms of priority. So losing trades are definitely a part of trading, and something which most traders really find difficult to accept. Now, important point, and you and I are aware of this simple fact, that you cannot control a trade. Once you are in a trade, the market takes over, and you cannot control the price movement. You may be right in your analysis, you may be incorrect in your analysis, but the market takes over completely. What you can control is the management of the ongoing trade, right? So this is where your risk management policies come in. Now, of course, every trader wants more winning trades, so you would concentrate on the win-loss ratio. The natural assumption is that larger number of winning trades would lead to greater profitability or growing of the account, but this is not true. Now, this is very important. This is a wrong thing. This is a fallacy a lot of traders tend to look at. Let's go over the risk to reward ratio. So understanding the importance of risk to reward ratio vis-a-vis your win-loss ratio. Now, the risk to reward ratio, according to me, is one of the most important factors for your trading, and I define it as a thin line between success and failure. Let's go over some simple mathematics to understand the importance of this risk to reward ratio. Again, like I said, these slides also, I will be sending a copy to you, so you have a copy of the slides, plus we are recording this session. Let's assume a basket of 10 trades for a calculation. Now, when you measure your performance, you cannot measure your performance over one trade or two trades, not even over 10 trades. You need to have a basket of larger number of trades to see that your system is effective, to give the system time to prove itself. But for calculation's sake, I'm just taking 10 trades. I mean, we could have just taken 100 trades, but I'm just taking 10 trades. Right, let's assume that we have a win-loss ratio of 50%, which means that out of every 10 trades, I'm going to have 5 winning trades and I'm going to have 5 losing trades. Now, this is a good win-loss ratio. Believe me, professional traders have a win-loss ratio, if I can put it that way, of about 60 to 70%. In my own trading, honestly, I still have a win-loss ratio of about 60 to 70%, which means that out of every 10 trades, I will lose 3 to 4 trades. And if you have a 50% win-loss ratio, you are an excellent trader, believe me. But again, a lot of traders find it very difficult to, accept this fact. But trust me, if you have 50%, if you are winning 5 trades out of 10, you are a good trader. And you'll understand why once we get into this. So out of these 10 trades taken, let's maintain one stop loss for each of the trades, right? I'm going to maintain a stop loss of, let's say, 20 pips for each trade, just as a number. I mean, I could have taken 40, but it's just for calculation's sake. Now, if my stop loss is 20 pips, that means my expected profit from the trade, if I want to maintain a risk to reward ratio of 1:2, must be at least 40 pips, right? Now, taking the calculation, I have 5 losing trades at 20 pips, I lose 100 pips. I have 5 winning trades at 40 pips, risk to reward ratio 1:2 I've maintained. Every trade has a profitability of 40 pips. Again, this is just ideal situations. You'll never have each of them go exactly the same, but just for calculation's sake. So I have a gain of 200 pips. Net result after 10 trades, I have 100 pips in my account. So in spite of having 5 losing trades out of 10, I am growing my account. 100 pips is a very good, profit to have in your trade. Let's go to scenario 2. Let's change the risk to reward ratio of 1:1. Change it to 1:1. I'm maintaining the same win loss ratio. So 5 losing trades, 20 pips each, I lose 100. 5 winning trades at 20 pips each, risk to reward ratio is 1:1, I win 100 pips. Net result after 10 trades, 0. My account did not grow. And to be very honest, if after 10 trades, if my account is not growing, then don't you think I'm just simply wasting my time? Right? I need to show something for the efforts I put in, for the time that I put in, for the efforts I put into my trading. Let's change this and let's go to scenario 3, where I bring the risk to reward ratio down to 1:0.5. Now, which is what scalpers tend to do, right? So you would place a stop loss of 20 pips and look for a profit of 10 pips. And in Forex, it's a very common thing. And let me tell you something, honestly, scalping does not work. One, your mathematics are against you. And in Forex, because of the nature of price, the spreads, the movements, strong movements, the not getting fills in the correct place, you would probably tend to lose more than you would win. But I still see traders doing this. That how difficult is it to take 10 pips out of the market every time I sit to trade? Not difficult at all. What if the market goes against you? Where's your stop loss? This is where they tend to lose. So what they do is they'll place a wider stop loss of 20 pips. And when I get about 10 pips or maybe even 5 pips for that matter, I'll get out of the trade. I'll take my money and I'll get out and I'll come back later again. Now do the mathematics. You have 5 losing trades, same win-loss ratio. You're losing at 20 pips, you're losing 100 pips. If I have 5 winning trades now, I'm gaining only 50 pips. Net result after 10 trades is negative. Simple mathematics. Now, this is something a lot of traders don't really look at, but it's just, as I say, the numbers don't lie. Now, what we did in all 3 scenarios, we maintained the same win-loss ratio, but the results of the trades varied drastically. So you can obviously conclude that your risk to reward ratio is more relevant than your win-loss ratio. To consider this or to demonstrate it further, let's take a scenario where we maintain the risk to reward ratio at 1:2, but now let's reduce the win-loss ratio to 40%. I'm not increasing it. If you're a good trader, you'll get 60%, you'll get more winning trades. But an average trader, I would say, has generally more losses than wins, which again, if you keep your risk management in place, it's not a bad thing. So if I have only 4 winning trades out of 10, but I still keep the risk to reward ratio at 1:2 as per my golden rules, 6 losing trades at 20 pips, I lose 120. 4 winning trades at 40 pips, I win 160. My net result is still positive. Now see the importance of your risk to reward ratio, right? So your win-loss ratio can vary, but your results depend more on your risk to reward ratio. Now this is one chart. It's not mine, to be very honest. I came across it on the internet, on the web, somebody else's. I really don't know whose it is. I've just put it over here, but it's a great example of your win-loss ratio versus your risk to reward ratio. Now, if I keep my risk to reward ratio at 1:1, I must have a win-loss ratio of at least 60% to be profitable, minimum. Anything less than 60%, I don't make money. On the other hand, I look at this factor over here, where my risk to reward ratio is 1:5. Even if I have a profitability of 20%, which means 2 correct trades out of 10, I still make money. Now, this is a very important factor. This is something every trader must be aware of. It's a good chart to have. I know some traders, honestly, when I've talked to them, they've taken a printout, and I know one trader of mine, at least, he has stuck it to his computer, saying that this is what I need to follow. These are the mathematics, figures don't lie. Let's go ahead. So maintaining your risk to reward ratio is crucial. But now let's get a little more into the detail of it, right? Not every instrument may give you the required risk to reward ratio that you're looking for. Now, the market that you trade, the time frame that you trade, should be based exclusively on the fact that you should achieve a minimum risk to reward ratio of 1:2. And different instruments, let's go into a little detail of that. So there are different instruments we trade, right? There's currencies, there's futures, there's equities, there's commodities. How do you decide what instrument should you trade? How do you really decide what time frame should you be trading on? Now, once you decide on an instrument, your instrument also has to be decided on the fact that you are going to get a risk to reward ratio when you're trading that, which simply means that that financial instrument must have sufficient volatility. It must have movement to give you that expected risk to reward ratio of 1:2. Once you've decided on the instrument, the question always arises basically what time frame should I trade on? Now, most traders decide this by a simple thumb rule, right? How much time can I devote to this business? And I'm calling it a business. If I have all day long, I'm just concentrating on trading. I can be a day trader because I can sit and watch my charts. I can follow the price movements all day long. If I have some other commitments, I have work, and I can devote certain times of the day to the market, then I can decide on a swing trader. Like in Forex, I always recommend that go in for a 4-hour time frame, which is more of a swing trader. You need to check your charts maybe twice or thrice a day, 3 times a day. Every 4 hours you can check it, or every 8 hours you can check it, which is enough. So it depends on how much time you're giving to the market. Right, so we decide based on this, but what we should be deciding, the instrument that I trade, the time frame that I should be trading on, should give me the required risk to reward ratio. Only then it's worth trading that particular instrument and that particular time frame. Let's get into specific examples of this. Right now, when I talk about a risk to reward ratio, this is something which I mentioned earlier, that you must have a system. We are coming back to the method. Like I said, it does not undermine the importance of the method, but you must have a method. Simple fact is, before you enter the trade, you must have your trading parameters in front of you. That's your trade plan. That this is my entry, this is where I'm going to put my stop, this is my expected target, this is the amount of risk I'm going to take on this trade. These are the steps of trade management that I'm going to note down. If the trade goes against me, which it can, this is what I'm going to do. If the trade goes in my favor, how do I manage my trades? How do I take some profits? What is the stage that I can move my stop loss to protect my capital? Now, this is essentially a part of a trade plan. You must have this written down before you enter the trade. Most traders, new traders, retail traders, I'm telling you about retail traders. I mean, all the folks in this room, you've come to my sessions earlier, and I'm assuming that you all are experienced traders in that sense. We do not take a trade on what I call as a knee-jerk reaction. Price is going up, so, I'm going to miss out and let me enter the trade. Do you have a trade plan? Do you have a reason why you enter the trade? Do you know where your stop is going to be? Do you know what your target is going to be? Do you know how much of risk you're going to take? Unless you have these factors written down in front of you, you're not trading, you're gambling. Now, this is important, right? So you must have a trade plan. So RR ratio, risk to reward ratio, is decided before we enter the trade. It depends on whatever technique I'm following. Now, let's take the risk to reward ratio. I've got an example of a 4-hour chart. This is a trade sometime back, which I had actually taken on the Euro New Zealand. This is based on a divergence, and I'm going to talk only about divergences over here for a reason. I'm going to come back to that. So this is a bearish divergence. As you can see on the chart, you can see that price made a higher high, your indicator made a lower high. But what we do with the divergence is we don't go back to the indicator after that. I will use an indicator to determine a divergence, but then I will confirm with Fibonacci's, I will confirm with price, and my entry is based on advanced Fibonacci levels, combination of various factors. My expected targets are based on Fibonacci's different Fibonacci levels. So I know that. Now, what I did have was on this trade, I remember my target one, as you can see over here. Let me just get back to this guy. So this was my expecting price to go down, right? And this was my trade. This was my entry right here. This was my target one. Now this target one, and this was my stop loss. My target one had a risk to reward ratio of 1:5, which is much more than the 1:2 that I am looking for. But because this is a longer term time frame, these kind of things are possible. And then we managed the trade. We had our target 2, our target 3 set up over there, that in case price decides to go further, where will it go? Where will it stop? This went up to a target 3. I remember my trade got closed because I had set my target over here, set and forget type. My target 3 had a risk to reward ratio of 1:10, which is phenomenal. But this advantage of trading Forex is because it trends, and once price starts moving in a direction, it can give you huge moves. But this is just on another point, right? So on a 4-hour chart, on a longer term time frame, I have much more than 1:2 that I aimed for. Let me take a similar divergence. So the parameters for your divergence are the same on a 1-minute chart. This is a 1-minute chart. The parameters remain the same. Your divergence conditions remain the same. You had price making a higher high, your indicators making a lower low, and you were expecting price to move down. But since you're on a smaller term time frame, the frequency of movement obviously is smaller. So this was your entry. This was my expected target, my target one. My risk to reward ratio was 1:1.6, less than 1:2. Now this mathematics simply tells me that I should not be trading on a 1-minute time frame because I am not going to get my risk to reward ratio 1:2. It's just simple maths. Now this is the point that I'm trying to make over here, is what time frame you're trading on, the instrument that you're trading on has to be decided whether you are going to achieve that 1:2 risk to reward ratio, minimum 1:2. Now going over this particular scenario on the 4-hour, right? So we had a risk to reward ratio of the first target of 1:5. Now because my risk to reward ratio was higher, I can afford to reduce my win-loss ratio. So let's assume that I have a win-loss ratio of 20%. That means out of every 10 trades, I win only 2 trades and I lose 8 trades, which is not good, honestly. You should not be doing that. If you have a good system, you should be having a much better win-loss ratio based on this. But worst case scenario, if I achieve or maintain a risk to reward ratio of 1:5 for this, 8 losing trades, 20 pips each, I lose 160 pips. 2 winning trades at 1:5, I make 100 pips on each trade, 200. After losing 8 trades out of 10, my account is still in positive. Now you see the importance of your risk to reward ratio. Regardless of the method you're following, regardless of what system you're following, just try to maintain your risk to reward ratio at a minimum 1:2. Higher the risk to reward ratio, the more losing trades you can afford to have. Now I look for a risk to reward ratio of minimum 1:3 in Forex. 1:2 is the minimum, of course, but 1:3 is highly achievable. And my way of looking at it is my one winning trade will take care of 3 consecutive losing trades if I have them. Now that's what keeps my account growing, right? So this was the importance of your risk to reward ratio. Let's take some other instruments, commodities, crude oil. Futures, you can trade on smaller term time frames. This is a 1-minute time frame on crude oil, same divergence, but you are maintaining your risk to reward ratio. The entry, the target, the stops, everything is based on the same parameters of divergence that we follow. Whether it's a Forex 4-hour chart, whether it's a Forex 1-hour chart, whether it's a crude 1 minute chart, whether it's an equity weekly chart, the parameters of the system remain the same. So in this, on a 1 minute chart, I can get a risk to reward. On this trade, there was a risk to reward ratio of 1:3, which means in the futures market, I can afford to trade on smaller term time frames because I can achieve my risk to reward ratio. Let's take another one. This was an index, the NASDAQ, again in the futures market. Now, to just give an experience of varied time frames, I'm taking this on a 15-minute time frame. But indexes like the NASDAQ, the Dow Jones, the S&P, like crude, they can be traded on smaller term time frames. On a 1 minute, you will get decent risk to reward ratios even on that. Now on a 15-minute time frame over here, this was a trade again based on your divergence, a bearish divergence, where the risk to reward ratio was almost 1:3, which is great, right? So in indexes, so if I want to trade indexes, I must make sure that if I trade on the 15 minutes, I'll get a good risk to reward ratio. But I should, even if I'm going on a smaller term time frame, I should be able to maintain a minimum 1:2. Equities. Now this is one trade which a year back or so. This is a weekly time frame, all right? Now this is a company I am doing some consultancy for a Dubai-based company where I give some trading advice on equities. They follow equities also. So this was a bullish divergence. Can you see this price is making a lower low? And your indicator was showing the great loss of momentum coming up over here. Now this was a chart which I had actually sent them. Again, look, this was a weekly time frame. Wells Fargo and Company. So this is where I would want to take entry. This is my target 1, this is my target 2. Parameters remain the same. These were decided based on Fibonacci's and a lot of factors that we look at. And again, I've kept this as a reference because it is effective. What happened to this trade was at least the first target got achieved. It did go almost halfway through, and I remember they closed off this trade over here. Again, simple facts is my advice was at that time, let's close it off over here. Let's first talk about one target achieved, risk to reward ratio 1:3, waiting for the second target, but price kind of stalled over here. And looking at simple things, then if you had attended my previous webinar that we did a couple of weeks back on, the looking behind technical analysis, deciphering the charts, the simple fact is that you had a good amount of sell orders over here. So which stalled price, and the advice was, let's get out of the trade. Let's not wait for price to go to the second one. A lot of factors that we tend to look at over here. Anyway, so this was in equities, risk to reward ratio of more than 1:3. Of course, if a fund is trading equities on a weekly time frame, this move probably took 4 or 5 months to complete. But it depends on what every trader is doing. So this is an example on equities. So bottom line, your risk to reward ratio should define your trading time frame. Maintaining the minimum RR ratio 1:2 is crucial, and I call it crucial. And you must select a time frame and an instrument that will give you this. Now, trading on larger time frame is always advantageous, especially in Forex. Now, I'm more of a Forex trader because, to be honest, again, something which we mentioned in the last webinar, that this is where the institutes, the banks are trading. So you want to be trading along with them. So obviously trading on larger term time frames make your systems more effective. If you decide to trade on smaller term time frames, and this I mentioned last time, that when even today, that scalping in Forex really does not work. You go down to smaller term time frames, you want to take some small quick movements or quick pips out of the market, you have to take into account your spreads, your commissions, your not getting filled because you don't have an exchange that there in Forex. You have your broker who might increase the spreads, the fills will not be correct, so you are at a disadvantage. What you should do if you want to go on smaller term time frames, now it's not that you should not ever trade on smaller term time frame. If you must, see to it that your risk to reward ratio 1:2 is maintainable, then you're allowed to do that. Now, this is important. This is your selection process, which will keep you out of a lot of trouble, right? So this was the money part of it. The three M's, the mind factor, simple. Let's just go quickly over it. I simply call it discipline and patience. And I have the saying on my website that trading requires the discipline of a soldier and the patience of a saint, literally. So it's what we call as psychological trading. Accepting losses, not very easy. A trader must learn to accept losses. Maintaining a stop loss. I hear a lot of excuses for traders who don't keep a stop loss. That the broker can keep my stop, he can see my stop, and then he will drive price to take out my stops. I get stopped out. But this is exactly what happens. This is what we discussed in the last webinar that we went over. That's exactly what they tend to do. And you have to avoid that by maintaining the correct stop losses at the correct levels. This comes down to technical analysis or doing this. Right. So another part of it is hoping for a trade to come back. Price goes against you, you move your stop loss further, or you just remove a stop loss. I'm sure it'll come back. It's what we call as getting married to a trade. The worst thing you can do, believe me. Price goes against you, take the stop, take the hit, get out of the trade, move to the next trade. But it requires a lot of discipline to be able to get to that stage. Revenge trading, another thing which has happened to me, which happens to everybody. You lose money, the next trade you go into, you just throw your risk management policies out of the window because you want to recover your losses. Now, one important point I would like to make over here. Somebody had asked me this question, that are traders naturally born good traders? If somebody's a good trader, do you think that this guy was a born trader and I can't do that? No, it's not. The good traders are the ones who have stuck around, who've been there, taken losses, learned from the losses, accepted all these things, and moved on. So the mind factor is a skill which has to be developed like your technical analysis skill. And this comes from experience, nothing else. It's what I call comes from the school of hard knocks. You have to take losses, understand it, see where you're going wrong, get yourself prepared that this is where I'm going wrong. I am not going to do this from next time onwards. It's human nature. You will keep doing it. But the more you trade and the more you accept your mistakes and see where you've done that, the more successful you will be. So I call it that your mind factor is a skill that has to be developed, which comes from experience, which comes from the fact that you cannot become a successful trader overnight. It takes time. All right. So there's a mind factor. Now coming back to the method. Now all the examples I showed you were of divergence. That's my primary trading technique. And another reason why I'm going through this, there are a lot of other techniques that we do follow. But this divergence is based on the concept that institutional traders create traps for retail traders. Now, everybody knows divergence. I'm sure everybody, all of you know what divergence is, but there are different ways. There are different classes of divergence which most traders are not aware of. There's a class A, there's a class B, and there's a class C. All three of them are not effective. It's only the class A which is one of the most effective ones, which has a high probability. And we identify those properly and trade those. Now this is something, divergence is created again something which I went over last time. So you have a support level over here, right? And a lot of traders will place anticipatory orders that if price comes back to this support level, we expect price to move down. And obviously if they place their buy orders, anticipatory buy orders, they will keep their stop losses below this support level. If you know it and I know it, the institutes know it. So what they will do is they will tend to drive price beyond this, take out the stop losses. And I like this image because it's like collecting all the fish in a net. And you collect all the money from the retail traders and then your price moves in the direction. And this creates the divergence, which is one of the reasons why the divergence is so effective. And this is something that we follow. So the divergence is a method. Now I'm doing a workshop in London. Coming back to London in the month of July. It's a 1-day workshop where we'll be going over the advanced divergence techniques with advanced Fibonacci levels, going through everything, the proper tools that you could trade. Right? And that is the reason why I introduced divergence here also. This is one example of a trade. So as you can see, this was the divergence. Again, this was a live trade and I had placed an anticipatory order. So sorry, pen. Price made lower lows. We had this indicator making higher highs over here, higher lows, my mistake. And I'll show you in the next chart. This is what happened. And price came and stopped exactly at the designated target, because this target was based on the Fibonacci level. You can see this low, you can see this indicator making highs. So this is a classical example of a divergence. This happens often and this is very effective. This was a divergence on an Australian company. I was doing a session for the Australian Technical Analyst Association. I do some sessions for them and we talked about this. Again, I'd mentioned risk to reward ratio over here. The NCM is some Newcrest mining company based out of Australia. A good bearish divergence, as you can see, good risk to reward ratio 1:4. Price came and stopped exactly at the target. So this works. Now, the point I'm making over here is this 1-day workshop that I'm doing in London is going to be a culmination of all these factors. How to identify your divergence correctly. How do you get the correct tools? How to use advanced Fibonacci levels? How do you use the trend lines correctly? How do you identify your support resistance zones? You can call them supply and demand zones, but with a twist, with something different, because this is something which I have learned from the banks. I have learned this from institutes as to where they keep anticipatory orders and where they expect the retail traders to place orders and where they will drive price, at what Fibonacci level they'll drive price to. And letting you on a secret, it's not the 61.8 golden mean ratio. It's another ratio which we have talked about earlier. So if you want to really understand divergence, this is the workshop for you. Combining advanced divergence, advanced Fibonacci ratios, the working tools, the practical tools which the institutes use. All right, so you can register on my website if you're interested. For more information, please visit my website. This is my email address, sunil@fibforex123.com. Feel free to get back to me if you have any questions. I mean, you need not be a student of mine, as I always say. If you have any questions, I always answer any question anybody sends me. I always respond. It's always been my intention to show you that this is the correct path. That's about it. All right. And please do follow us on social media. So this is Facebook, Twitter, LinkedIn. Give us some likes. I have a good YouTube channel. A lot of videos are up on the YouTube channel. Get in touch if you have any questions. All right, so that brings us to the end of this important and practical session. Okay,